silver did have its own unique drivers in this leg up. It wasn't just tracking gold. It started zooming higher. And my interpretation is not unique to me. A lot of people were commenting on this. We had a physical squeeze in London. And I think that's what made silver really perk up. And this is actually good news, because that physical squeeze, that, I know that there's some uber bulls that think this is it. Silver's going to the moon. The shorts are all going to be busted, and silver's going to triple digits next. Yeah, maybe.
Lobo Tiggre, founder of independentspeculator.com, shared his take on silver's recent surge, noting that the metal's move wasn't merely a reflection of gold's performance. It had its own powerful catalysts. He explained that a developing physical squeeze in London was a key factor behind silver's sharp rally, as tightness in physical supply began to drive prices independently. While some ultra-bullish voices believe this marks the beginning of silver's moonshot into triple digits, Tiggre urged a more measured view. The squeeze, he said, is a constructive sign, evidence of growing demand meeting limited availability. But investors should stay grounded and watch how this pressure unfolds. If anything, it shows silver's strength is rooted in real fundamentals, not hype. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Right. Well, first and foremost, I do still see silver as a monetary metal, and it has been tracking gold more closely this year than copper, which may sound like, well, duh, it's a monetary metal. Well, but it wasn't last year. It was tracking copper more closely than gold last year. So I'm very encouraged by this action because I'm bullish gold. And by the way, I'm bullish copper as well. So how can you be bullish gold and copper and not very bullish on silver? So it's, the very last interview I did, I think I said something similar, and like clockwork, one of the first remarks was, "This man hates silver." Oh, well, what can you do? Anyway, but the reason why I'm teasing this apart is because silver did have its own unique drivers in this leg up. It wasn't just tracking gold. It started zooming higher. And my interpretation is not unique to me. A lot of people were commenting on this. We had a physical squeeze in London. And I think that's what made silver really perk up. And this is actually good news, because that physical squeeze, that, I know that there's some uber bulls that think this is it. Silver's going to the moon. The shorts are all going to be busted, and silver's going to triple digits next. Yeah, maybe. But if not, if the folks at the LME can sort out the physical supply issues now, and there is data that suggests they are as we speak, then I think silver, it doesn't necessarily go down or go into a bear market. I'm not saying that. I'm saying that the extra oomph that it got from the short squeeze goes away, and then silver goes back to trend. And for all the people who says, oh, he hates silver, not at all. I think this is very good for both gold and silver, because if silver really was finally catching up to gold, even your most diehard silver bulls will tell you that silver usually lags gold at first and then more than catches up at the end of the bull market. So if we were in that catch-up phase, that would signal the end of the bull market. And I don't think we're there. I'm a fundamentalist. I don't think we're there for all those reasons we articulated earlier. I don't want it to be there either. I want it to go higher. Mr. Market doesn't care what I want. But I neither want nor think that we're at the end of the market. So silver catching up to gold was a concern to me. Silver catching up because of the physical squeeze in London that did not apply to gold is a huge sigh of relief for me. And, we'll see where it goes next. This does mean I think that there's potentially more volatility to the downside in silver in the near term than in gold. But, that's not a surprise to anybody in silver and gold. We all know that silver is more volatile than gold. I'm just saying beware of an extra spicy near term for silver. And if you're a bull, hey, that means more buying opportunities. And by the way, if you exercise some upside maximizers or whatever strategy you used, if you locked in some gains and now you've got extra cash in your trading account and we do get a sale price, well, that's a good thing. If you're an uber bull, the worst thing in the world is to have an obvious buying opportunity and no cash to act on it. I remember this in 2008. In late 2008, like particularly November, December, I had a lot of readers, they were long-term bulls. They got it. They understood that gold correcting down to almost 700, that was an opportunity. But the agony that I could hear in their voices, reading between the lines in the email, the agony was they see it, they understand it, but they were all in. They had no cash to act on it. So this is another reason why one should not let profit slip through your fingers. That doesn't mean you're a bear. It means, you don't want to lose money. Rule number one, don't lose money. And two, It means that you're providing for potential future opportunities.
Lobo Tiggre discussed the recent movements in silver, emphasizing that the metal has reasserted itself as a true monetary asset this year, tracking gold more closely than industrial metals like copper. He views this as a healthy sign within the broader precious metals bull market. The surge, he explained, was primarily driven by a physical squeeze in London rather than speculative mania. While some overly optimistic investors expect triple-digit silver, Tiggre believes the squeeze added temporary momentum. Once supply issues normalize, silver will likely return to its fundamental uptrend, not collapse. He cautioned that volatility may increase in the short term, but for long-term bulls, those swings can offer rare buying opportunities when others hesitate. Let's get into the interview.
I think that the central bank gold buying, I think the global allocation, the political risk, the global reallocation, Rick Will's famous 2% versus 0.5%, all these things happening right now, and not to mention inflation. The Trump agenda is highly inflationary. I know Trump fans hate it when I say that. That's not necessarily a criticism. Whether you agree or disagree with Trump's agenda, it is inflationary. Come on. I mean, Doge did not save us $2 trillion. Europe's rearmament is highly inflationary. Russia's war is highly inflationary. The only one that's really been dealing with something that at least reportedly looks like deflation is China. And ultimately, they just announced a new 5-year plan. So ultimately, the printing press always wins in the end. So all of these reasons, I think, are solid reasons to remain bullish on monetary metals in particular, but commodities as a whole. I like copper and uranium, other things too. So I'm not a bear, and I'm not telling anybody, no, I didn't say sell everything. And when I took profits on these upside maximizers, I didn't exit the positions. I just took the profits or maybe took sometimes I'll even leave the profit on the table and just recover the initial investment. So I'm risk-free. I really like it. And I'm bullish on the commodity. I'm bullish on the company, the project, the country, all these things. I'll leave most of the money on the table and only recover my initial investment so that I can't lose. It depends. One size doesn't fit all. As I say, the only way to do it wrong is not to do it at all. I'm not making a bear case. I'm simply saying, dear reader, nobody knows what the next move is going to be and how you feel if you let some gain slip through your fingers. And by the way, if the next move is down and you took some profits, now you have cash to take advantage of that. If you're all in right now, how will you feel if there's a sale price in a month or two and you have no cash to act on it? And the answer is, well, Lobo, what if it goes to the moon? Well, I've just answered that. I have more money now in the market than when I started. So if it goes to the moon next, that's fine. Okay. Maybe my 10-bagger turns into a 7.5-bagger instead of a 5-bagger. It's still 7.5 times my money. That's a fine outcome, Elijah. But to your point, the reason for this is some of the pushback that I've gotten when we were before this week's correction. When we're still in this hockey stick mode, a lot of the pushback I was getting for saying, hey, folks, whenever you got a hockey stick, nobody goes broke taking profits. Oh, and by the way, I said the same thing in early 24 when uranium went triple digits. And I got so much hate for anything other than uranium's going straight to the moon. And look at history. like look at what happened. So I was saying something similar about gold. I was not calling it top. I was just saying, hey, some correction here is not to be is not unexpected. And then I had chartists responding. But look, in 1979 when gold was screaming up towards $850 an ounce. Look at that chart. There's no correction in there. It's just a smooth parabola upwards. Okay, let's accept that. Let's stipulate that as, what happens as you go into the blow off top. As we were just saying before, I don't want this to be the blow off top. Mr. Market doesn't care whether I want it or not, but based on the fundamentals, I don't think we're there yet. So if we weren't there yet, looking for some correction, an interruption in that parabola made sense to me, right? That's not a bear case. It's just saying that, it's not an end market case. All right. And so I think this break is actually, people hate hearing about a healthy correction, but in the context of my longer term bull case, I actually do think this break is a healthy correction. Because if it just continues screaming upwards, well, Elijah, we would be looking at a blow off top. And, okay, I'm long. Our audience is probably long. We could make a lot of money in the near term in this blow off top if that's what was next. But that would be it. That would, the most likely thing after this vertical move would then be a bear market for years, like a screaming back down in the elevator and then a bear market for years. Who wants that? Now, again, Mr. Market doesn't care what we want, but I'm just saying, be careful what you wish for. Nobody goes broke taking profits. It doesn't mean you're a bear, and it does load you for bear. Like, if we get a correction, you'll have funds to do something about it with. And so, yes, I think this kerfuffle we've had over the last week is very encouraging to me. It tells me that we're probably not at the blow-off peak yet, and that is a good thing.
Lobo Tiggre wrapped up by stressing that the latest correction across gold and commodities is not a sign of weakness, but a sign of health. He believes strong central bank gold buying, global inflationary pressures, and political uncertainty continue to support the long-term bull case for hard assets. From rearmament in Europe to fiscal expansion in the U.S., the printing press remains the dominant driver, and that means inflation is here to stay. Tiggre urged investors to remain disciplined, take profits when markets become euphoric, and keep cash ready for the next buying opportunity. He reminded that parabolic moves often mark the end of bull cycles, not their continuation, and this recent pullback likely saved the market from a premature blow-off top. If you value thoughtful, disciplined analysis, be sure to like, share, subscribe, and add your insights below.